So, Julia, we can perhaps kick off with you. Challenger's the one we haven't mentioned so far. A pretty big drop in the overall number on the headline. Take us through the result and what we should make of it and how the shares might react today.
The headline number was quite dramatic and we did see a fall there, and that's because of the volatility investment earnings. But the fact is that Challenger holds its fixed interest products till maturity, so the mark-to-market calculations aren't really that important. In fact, if we have a look at normalised profit, we actually saw it up by 20%, coming in ahead of expectations at $297 million, and it has beat its own forecast. If we have a look at FY12 guidance, it was for retail annuity growth of 30%. We've actually seen growth of 34%, so that makes it a record for the full year as well as for the second half. They were predicting retail net book growth of 10%. We've actually seen growth of 10.4%, and net income growing by 7%, really being boosted by life earnings. And while the market is quite volatile, I guess this is one company which has actually benefited from the volatile markets because the annuity style products have become more popular. So in terms of FY13, we're seeing some strong guidance once again. They are expecting annuity sales to grow by around about 15%. They're expecting to see the retail net book grow by another 10%, and predicting that cash operating earnings will come in between $440 to $450 million. So despite the quite dramatic fall in the headline number, the normalised profit result has come in ahead of expectations, and all other metrics which the company has forecast it's managed to beat this morning.
Say, you know, forget the past, we've kind of dealt with that, look to the future, and the company head today saying globally they're well positioned for growth. Do you think the market's convinced by that though, those shares down 1.25%?
I think BlueScope still has had a good run from its announcement last week, so I don't think it's really a reflection of the result coming through today, because that was already built into the stock. When we heard about that deal with Nippon Steel, we knew that the loss would be just above $1 billion there, and that deal last week, that was announced last week, really gives BlueScope a new, I guess, breath of life. It gives it the opportunity to now go out and find growth opportunities and to buy into companies which will help it in terms of its future growth. So it's helped it on the debt front. We know that it had a debt issue that it needed to pay off next year, so it's cleared the deck somewhat in terms of the debt concerns that the market has had. And secondly, it's provided BlueScope with the opportunity to now go spending in order to provide future growth. So I think a bit more hope in BlueScope than a couple of weeks ago with this deal that was announced with the Japanese steel company, an array of life for BlueScope. But the result that came out today really baked into BlueScope's share price.
Yep, we will move on. Just quick, get your take as well, Julia. Back on the bags, of course, come back for obvious reasons today. Really seeing the broader market just constrained. It's ex-Devon down over 4%. Bendigo and Adelaide losing about 1.3%. Now, just put it into context, that one, with what you're watching for from this stock more broadly.
Sure. Bendigo and Adelaide has just come out with its profit results, so I haven't had a chance to drill into all the numbers. But the key to this result is asset quality and funding pressures. We know that the Big Four have an advantage in terms of diversification and in terms of scale, and the regional banks really struggle in this area. The headline number, the cash profit number of $323 million, actually bang on consensus estimates. So that's coming in line with expectations. The dividend of 30 cents also coming in line with expectations, so that takes a full year dividend to 60 cents, so no real surprises there. The net interest margin I haven't been able to see, but we were expecting to see a number of 1.8% and expected it to fall by 3 basis points in the second half, helped along by that February 15 basis points repricing where we didn't see we saw that move by Bendigo and Adelaide to reprice its products. But of course recently we've heard that it sold its IOOF stake, so that should give it $110 million, so that should add on to statutory profit by around about $40 million. So all in all, a difficult environment for the regional banks, but it does look like Bendigo and Adelaide are coming in line with market expectations. Having said that, if we have a look at how the shares have performed coming up to this result, this is the 30-day chart, and you can see that the shares have been rising into the result. So it could be a case of buy on the rumour, sell on the fact, and the result coming in line with expectations.
Dare I say it, of a Woolworths back they're making a play.
Peter likes that idea as well, but Julia, to you.
I think it's a very difficult environment for a takeover of a regional bank. If anything, it would come from our own backyard, and that's because what we are seeing globally are the global big, huge banks coming under pressure. What they're doing is reducing their asset base, they're deleveraging, they're getting rid of some of their loan book, and that provides opportunities for banks like ANZ in the Asia-Pacific region, where a big gap has been left by some of the European banks and those global banks which do face stricter capital adequacy rules from Basel II. So altogether much more difficult for banks. The Australian banks are the strongest, or some of the strongest in the world. So if the takeover for Bendigo was to come, it'd be most likely from an Australian bank rather than from an international bank, where we know that cost cutting, asset sales as well as deleveraging is the order of the day rather than expansion through acquisition.